Hey everyone, welcome back to the channel. Today we're diving into a topic that's on a lot of people's minds, recessions. It often feels like one day everything is fine and the next, news headlines are screaming about an economic downturn. But the truth is, the economy usually sends out warning signals long before the official announcements. Being able to spot these signs can help you prepare, both financially and mentally. So let's talk about the 8 key indicators that often appear before a recession hits the mainstream news. Stick around, because understanding these can make a huge difference. First up, let's talk about the yield curve. Now, this might sound a bit technical, but the concept is actually pretty simple. A normal yield curve slopes upward, meaning long-term government bonds have higher interest rates than short-term ones. This makes sense. You'd expect a better return for locking your money away for a longer period. But sometimes this curve inverts. That's when short-term bonds start paying more than long-term ones. This is a classic and historically very reliable recession indicator. Why? It signals that investors are nervous about the near future and are rushing to lock in their money in safer, long-term assets, even at lower returns. They're basically betting that interest rates are going to fall soon, which the central bank often does to stimulate a weak economy. An inverted yield curve has preceded nearly every U.S. recession in the last 50 years. So when you hear financial news mentioning an inverted yield curve, pay close attention. The second signal is a noticeable slowdown in the housing market. Housing is a massive part of the economy. When things are good, people feel confident buying homes, taking out mortgages, and spending on renovations. But when a recession is looming, the sector often gets hit first. You'll see a drop in new housing starts. That's the number of new residential construction projects beginning. You'll also see a decline in existing home sales. People become hesitant to make such a huge financial commitment when they're worried about their job security or the economy's direction. A cooling housing market doesn't just affect real estate agents and construction workers, it has a ripple effect. Less home buying means less spending on furniture, appliances, and home improvement, which can drag down the broader retail sector. Indicator number 3 is a consistent drop in consumer confidence. This is a big one because consumer spending is the engine of the U.S. economy, making up about 70% of it. The Consumer Confidence Index measures how optimistic or pessimistic people are about their financial situation and the economy in general. When this number starts to slide month after month, it's a red flag. Why? Because when people feel uncertain, they change their behavior. They cut back on discretionary spending. That means fewer dinners out, delayed vacations, and holding off on buying that new car or TV. This drop in spending directly impacts businesses' bottom lines, leading to lower profits, and eventually, it can lead to layoffs as companies tighten their belts. It's a self-fulfilling prophecy in a way. Worry leads to less spending, which creates the very economic slowdown people were worried about. Moving on to our 4th sign, a rise in the unemployment rate. This one might seem obvious, but we're looking for the subtle early shifts. Before mass layoffs make headlines, the unemployment rate will often start to tick up slowly from a very low point. You might see what's called a bottoming out of the unemployment rate, where it hits a low and then begins a steady climb. Initially, it might just be a few tenths of a percent, but it's the trend that matters. Companies often try to avoid layoffs until they absolutely have to. So an increase in unemployment is often a lagging indicator, but the start hours of the increase is a leading signal. Another related metric to watch is initial jobless claims, the number of people filing for unemployment benefits for the first time. A sustained increase in weekly jobless claims is a clear sign that the labor market is weakening. 5th on our list is a decline in business investment. Just like consumers, businesses also get nervous about the future. When corporate leaders see storm clouds on the horizon, they pull back on spending. This is known as a drop in capital expenditures, or CapEx. They postpone plans to build new factories, upgrade equipment, or invest in new technology. You can see this reflected in data like durable goods orders. When orders for big-ticket items that are meant to last for years, things like machinery, computers, and transportation equipment, start to fall, it shows that businesses are losing confidence in future demand. This lack of investment not only slows down current economic growth, but also hampers future productivity, making the potential downturn more severe. It's a sign that the people with their finger on the pulse of industry are getting ready to bunker down. Our 6th indicator is a little more global, a slowdown in manufacturing. The manufacturing sector is highly sensitive to the economic cycle. One of the most watched metrics here is the ISM Manufacturing Index, or PMI. This index surveys purchasing managers at manufacturing firms across the country. A reading above 50 indicates that the manufacturing sector is expanding, while a reading below 50 indicates that it's contracting. When the PMI consistently dips below 50 and stays there, it's a strong signal that trouble is brewing. Manufacturing often leads the broader economy because when demand for goods starts to soften, factories are the first to feel it. They reduce production, cut back on orders for raw materials, and eventually may have to reduce their workforce. It's a canary in the coal mine for the wider economy. Next, let's look at signal number 7, a spike in oil prices. While not always a direct cause, a sharp and sustained increase in the price of oil has often preceded recessions. Think about it. Oil is a fundamental input for almost everything in our economy. It fuels our cars, trucks, and planes, and it's a key component in plastics and many other industrial processes. When the price of crude oil skyrockets, it acts like a tax on the entire economy. Transportation costs for businesses go up, which gets passed on to consumers through higher prices. At the gas pump, higher prices mean consumers have less money to spend on other things. This combination of rising business costs and squeezed consumer budgets can be enough to tip a fragile economy into a downturn. Finally, our 8th indicator is a change in the stock market's character. Now, the stock market is not the economy, but it is a powerful barometer of investor sentiment about the future. We're not just talking about a one-day crash. We're looking for a sustained bear market, which is generally defined as a drop of 20% or more from recent highs. More than just the headline numbers, look at which stocks are falling. Typically, in the lead up to a recession, you'll see cyclical stocks. Companies in sectors like travel, luxury goods, and automotive that do well when the economy is strong start to underperform. Meanwhile, investors will flock to defensive stocks. Companies in sectors like consumer staples, utilities, and healthcare, which people need regardless of the economic climate. This rotation from growth-oriented to defensive sectors is a classic sign that smart money is preparing for a slowdown. So there you have it, 8 key signals that can warn of an impending recession before it becomes common knowledge. The inverted yield curve, a slowing housing market, falling consumer confidence, a rising unemployment rate, declining business investment, a contraction in manufacturing, a spike in oil prices, and a shift in the stock market. No single indicator is a perfect predictor, but when you start to see several of these signs flashing red at the same time, it's a strong signal to be cautious. Understanding these can help you make more informed financial decisions, whether that's building up your emergency fund, rebalancing your investments, or simply being mentally prepared for what might be ahead. Knowledge is power, especially when it comes to navigating the economy. Thanks so much for watching. I hope this breakdown was helpful for you. If you found value in this video, please give it a thumbs up and consider subscribing for more content on finance and the economy. Let me know in the comments which of these indicators you're watching right now. Stay safe, stay informed, and I'll see you in the next video.